From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. And coming up, high-stakes negotiations with China get higher after an 80% tariff is floated by the president. After the Fed enters a wait-and-see mode as uncertainties cloud the outlook for policy. And all the unknowns keeping Treasury yields elevated. But we begin with the big issue, flying blind at the Fed.
The Fed is not really sure where tariffs are going to land.
They are stuck. They are on ice. They really can't do anything.
And the Fed is likely to just take a step back.
They're worried about the stagflationary shock.
They'll take baby steps and be very cautious.
Uncertainty has clearly risen.
Uncertainty is not going to get away.
Probability of recession has gone up.
Our recession scenario is 60%.
The question is, how long can the hard data hold up?
The bond market and the dollar matter far more today, as we sit here today, than the equity market and the economy.
You're not going to see, bonds move intraday in the way you're going to want them to move.
There's a number of catalysts that could point towards significantly higher yields. And I think a lot of it depends on the resolution of tariff uncertainty.
Maybe the Fed will not need to cut and might hold off longer. I think that's why that front end is moving.
Bonds will be the ballast in your portfolio.
We'll be buying bonds here.
The most powerful people in the world are the bond vigilantes.
Now let's take a look at the moves across the yield curve, because with the expectation of a slowing economy and the Fed potentially cutting rates this year, you did see the lower end of the yield curve, the shorter end, being driven down, but decoupling from that longer end even more. In fact, if you look at the 10-year in the yellow line here, we have inched higher, and since the end of April, we're actually more than 20 basis points higher on that 10-year, even this week, despite the Treasury Secretary heading over to Beverly Hills, talking to investors and trying to create some calm in that market. We've still seen a little bit of a sell-off. Now let's flip up the board here, look at the odds of a Fed rate cut in July, because they've started to taper off. And it's been interesting given those concerns around inflation risks, keeping those bets higher than before. We have seen a wavering between 3 and 4 rate cuts expected this year. But speaking of the Fed, New York Fed President John Williams speaking to Bloomberg earlier today, echoing Chair Powell's wait-and-see approach.
Right now, there's a lot of uncertainty about what's happening with trade policy or other policies. So for me, what's important is think through a lot of different scenarios. Right now, the economy is in a really good place in the U.S. Unemployment's in 4.2%, inflation's 2.3%. The other indicators show we're still a pretty solid economy. So right now, we have time, and once we have that more information, we can kind of think of, what's that mean for the achievement of our goals in our policy.
And joining us now, we've got Leslie Falconio. She's the head of Taxable Fixed Income Strategy at UBS Global Wealth Management. And the yield curve itself has been such an interesting conversation to be having. A bunch of investors over the last couple of days said, isn't this great for us? Isn't this great that we've seen a 50 basis point differential? However, it does mean that that longer end has been tailing off. What do you think?
Well, I mean, I think April's a perfect example of that. If you think about what happened in April, and what we've seen is a total twist in the yield curve. I mean, we've been calling for a yield curve steepener since the summer of 2024. But if you look at April, for example, you had the 2-year down about 25 basis points and that bond up 14 basis points and the 10-year up 3 basis points. So I think it's this twist that's really been interesting, and not necessarily the shape, the steepener, but how it's twisted. And, I do think that most investors are cautious on that bond, and they remain cautious on that bond.
But isn't twisting only good on a dance floor, frankly, Leslie? I mean, if you look at these kinds of volatility that we're seeing, people have gotten used to volatility. What they haven't gotten used to is where the 10-year is supposed to end this year or even next year.
Yeah, I mean, listen, I think that type of twist that we've seen, to your point, I mean, what that does is that really impacts people's model and forecasting, because it normally doesn't twist like that. I mean, I think that the issue and the shape of the steepener was something that the market was expecting, was something that we were expecting, but to your point, where the 10-year ends, I mean, we're still calling for the 10-year to end, around 4.25 or 4% at the end of the year, because we do think growth trends lower to that 1.5%. But that doesn't mean that in the interim, you can't get these moves higher in rates, as you mentioned earlier, from what we've seen to the end of the month. And I think this wait and see attitude with the Fed is, what we were anticipating. We think that the first cut is in September. We're expecting 3 cuts this year. but they have to leave their options open. And one thing that they don't want to do is cut preemptively and have a scenario like in September of 2024 where you cut and back-end yields actually move higher because everyone's concerned about reacceleration of inflation.
We'll talk about the short term in a second, but I do have another question about the longer end, because if you believe that yields could be lower, then would you buy, and would you buy with conviction at this level?
Not at this level, we wouldn't. I mean, we've been long the intermediate part of the curve, right? Which has become, a consensus allocation right now. I mean, most consensus is to stay away from the bond. I mean, everyone's in that sort of intermediate part of the curve. We entered the year in the intermediate part of the 5-year, and if you look at the correlations between, say, equity and fixed income, 5 years has been a great correlation. It's up, 3.5%, 4% this year, right? The bond has been the drag. We wouldn't buy necessarily right now, but as you move towards that, 4.5%, 460, 470, we would start to add and maybe start to extend. I mean, the 10-year has really been stuck in a range it's been volatile, but the range has really been, between, 4 and, 4.5% for quite some time. The intraday volatility has been great, but you haven't really broken out on a sustainable fashion out of that range for quite some time.
It's interesting. We were talking to AQR's head of macro a little bit earlier, and he's a fixed income expert, but says, don't count on bonds. To me, that was an incredible comment, because everyone keeps saying, look to the bond market, think about diversifying. But have bonds really been reliable in that front, given all the volatility we've seen around the tariffs and the uncertainty around the rate outlook?
Look, I think they have. I think that, the bond and the safe haven has been a little bit, the question of the safe haven has been a bit overblown. It does obviously depend on where you sit on the curve. And, that long end, that 30-year, there's no question. It's not an area of the curve that we've been recommending. We weren't recommending it entering this year. We weren't recommending it, at the beginning of the, fourth quarter of 24. But if you look at, that 5-year area, that has been actually a very good sort of, safe haven, if you will. And it has, proven to be the right correlation of the equity market. That is where you rely on the bond market. When you look at the longer end, the problem is the volatility has been so great that even those sectors that are of high quality nature, because of that volatility with that interest rate risk, your risk-adjusted returns aren't looking very good. So we do think that the bond is a place to be as a diversifier. You just need to pick your spots, until we see what happens, with a little bit more certainty in regards to tax cuts and deficit, as you go throughout the year.
It's interesting. When you look at rate cut expectations, we were up to 4 rate cuts a little bit earlier, just really a week or two ago. And now you're down to 2.7 roughly expected through the end of the year. What do you make of this? Ultimately, where do you think that the Fed can land, given where investors, the economy might be impacted by these tariffs?
Look, I mean, the fixed income market's forward-looking, the Fed is backward-looking, so you constantly have this convergence and divergence of what the market feels Fed policy path should be and what the Fed guides it should be. So now we're in a situation, in our opinion, where there might be 2 might be a little bit hawkish for us because we still think that is 3. But, I do think that the point is they will start to cut this year, and that is our expectation. I think the question becomes, when do we actually start seeing some of this, slower hard data, if you will, to merge with that soft data? And I think that's what the Fed is really waiting for. So I'm not surprised that we've seen it jostle around. Unfortunately, it'll probably continue to do so because you're going to have a lot of clouded data for quite some time in terms of when the actual impact of these tariffs come in, whether it's next month, 2 months, or 3 months. I mean, there could be a lag. So unfortunately, I think you're going to have this convergence and divergence for quite a long time. I think the key is to push against when they have extremes, like one thing we would do if you have 105 basis points of cuts priced in, and that's not our view, we push against that. And I think you're going to have the opportunity to do that for the rest of the year.
Leslie, the Fed earlier this week really did warn about the risk of stagflation. How worried are you about that risk right now?
Well, I mean, listen, it's always a risk. There's no question. It's with the labor market as strong as it is right now, it's hard to see that stagflation. But, look, it's always a point of concern. I mean, we'd have to see that labor market, weaken quite a bit, which is a possibility. That's not our call that we go into a recession. It's not our call that we have, negative GDP for several quarters. So, it's always going to be out there. I think it's always going to be a point of concern, but you have to wait and see whether or not, goods inflation, filters over to service inflation, whether or not the labor market, starts to really, shoot up in terms of the unemployment rate, but we're not seeing that now, particularly when we look at the claims data yesterday. So if that should happen, it's always going to be a point of concern. That was one of the start of the Fed commentary in their statement. I think it's going to be something that people watch, but right now you're going to have to see that slower labor market for that stagflation story to really fuel.
Leslie Falconio of UBS, we thank you for joining us today. Of course, have a great weekend to you ahead of another busy week of economic data. Now, up next, we're going to look at the auction block. Apple joins a rush of issuance that saw the high-grade market post its busiest pre-FOMC session in 5 years. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we look at the bond issuance for the week. And we start with treasuries because market watchers were worried about a buyer's strike. But instead, we saw good numbers for the 3 and the 10-year. The 30-year auction, though, did tail. In U.S. investment grade, big names like HSBC, Bank of America, and Apple headlined a week that saw total volume top the highest estimate. We also saw the first Friday deal since January, and high yield saw 4 issuers on Thursday, the most since February. One deal in particular, though, was sweetened to attract demand. The $4.3 billion sale to support Apollo's buyout of a suite of gaming and gambling products. The deal was one of the largest to test investor appetite since banks were left stuck with nearly $6 billion of debt that they couldn't sell during April's trading turmoil. And when it comes to credit, this week at Milken, we spoke to some of the biggest names in the industry, and they see opportunity amid all the volatility. Take a listen.
Everything going great. And then, of course, we had Liberation Day.
Right now, the real direction of attention is really to what's happening in Washington.
Obviously, it's a more complex environment the last number of weeks.
There's a reasonable case to be made that we have a probability of a recession slightly above 50%.
Our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
It's created a significant opportunity so far.
Find better opportunity to invest than the weaker credit at this stage of the business cycle.
We had this dry powder to step up and provide liquidity when other people couldn't.
We have $13 billion of dry powder. Very much open for business, very interested in providing that capital.
Private credit comes up in every meeting that we have here at the conference, and there are certain slivers of the private credit market that would do quite well in an area of lower growth or uncertainty.
It's been more decompression. Yeah. So there are companies that are going to be more vulnerable to tariffs, more vulnerable to, say, consumer discretionary. And so those spreads have widened out. Yeah. But largely, the indices have largely come back.
See how it all plays out.
Joining us now, Lotfi Karoui, Chief Credit Strategist at Goldman Sachs, and Richard Zogheb, Head of Debt Capital Markets at Citigroup. Now, riddle me this. Lotfi, if you're seeing issuance come back, that's a great thing for the markets. However, we had a story this morning talking about how the New York Fed is looking in to support repo operations as well. We saw that 30-year auction trail a little bit. What do you think this means for the longevity of this market when you do still see some fear in the Treasury market?
Yeah, I mean, it's interesting because that negative buzz around sort of the microstructure of the Treasury market is something that we've been dealing with for, 4 to 5 weeks now. On the credit side, I will tell you we haven't seen any of that. If anything, I would probably describe liquidity conditions in the corporate bond market as the best we've seen in, 15, 20 years. Now, if things get bad, I do think that the Fed has the tools to sort of, liquefy the market and make sure that, there's no sort of widening in that liquidity premium on the Treasury side. But I think what's been happening in the Treasury market has been largely contained there. And I do take comfort from the fact that we've seen absolutely no spillover into the corporate bond market.
Now, this week I was talking to Peter Toll over at Barclays. You heard a little bit from him in that soundbite, but he mentioned that there's a mountain of money when it comes to what's waiting on the sideline, particularly for riskier, for high-yield debt. Richard, are you seeing the same thing?
There's a lot of liquidity in the bond market, Sonali. You've got, if you think about what's gone on over the last 3 years, most of the issuance has been refinancing in nature, and so the market has not grown. And at the same time, you've seen the growth in assets under management in private credit. Private credit is taking away some of the supply, some of the assets from the broadly syndicated market. So you've got these fixed income investors who are quite liquid, really like the current state of underlying rates, want to put the money to work, and we've had a hard time creating the supply to meet that demand. So yes, I agree completely with Peter, with some of the other folks that you spoke to at Milken. There's a lot of liquidity out there right now in the fixed income markets.
What do you think about this inclination to take on credit risk right now, Lotfi? It sounds like you have such a large market of buyers out there outside of the debt market that is looking at equities and saying, well, wait a minute, we still are worried about downside risk. Why isn't that more true for high yield debt buyers?
I think you have to be mindful and respectful of the strength of the demand technicals. I fully agree with Rich. I think if there's one lesson you can draw from the last 3 weeks is that we still live in a world where there's an imbalance between too much demand and not enough assets. And I think the leveraged finance space is a great example and a great illustration of that, particularly in high yield, where net supply has been barely positive for the last couple of months. If you ask me to take a view on spreads, I don't think you're being paid for the kind of forward, macro environment that we'll have over the next couple of months. I think the market has essentially been telling you that we passed an inflection point in terms of peak uncertainty on the tariff side, but we've also passed an inflection point in terms of the degree of uncertainty vis-a-vis the broader macro outlook. That doesn't feel right to me. I mean, IG spreads are below 100 basis points. High yield is around 350 basis points. That is probably as good as it gets if you think that the next couple of months are going to feature an acceleration in inflation. There's nothing magic about that. It's actually mechanical. A deceleration in growth. And I think we heard it from Leslie earlier, a Federal Reserve that is in a very, very difficult position to be ahead of the curve and deliver those insurance cuts as it did in 2019. And so that sort of mix of growth, inflation, and policy isn't really, something that justify current spread levels. And so on spreads, I'd be a little cautious here. All-in yields, probably a bit more constructive.
Rich, how do you give a number or a perspective of how big that mountain of money is? Out of all the conversations I had this week, that one somehow stuck with me the most.
It's hard to put a big number on it because you used to see mutual fund flows. There used to be things that were publicly reported that would give you a sense. I mean, there's a quote of there's the quote that private credit has north of $2 trillion, but not all of that is dedicated right to normal way fixed income. A lot of it's targeted towards structured and the like. But look, I think you've got north of $1 trillion in private credit and well north of multiple trillions in the fixed income markets, the regular way fixed income markets that's available to be invested. And then the other thing that people spend a lot of time focus on and try to gauge is there's a lot of money in short-term money market funds right now. And at some point, when folks get the sense that the Fed is going to start cutting, and we don't, you commented that we've gone down from 4, the market was looking at 4 cuts and now it's maybe 2. But at some point, there could be some cuts, and when that happens, there's a chance that some of that money moves into longer duration fixed income as well. So I think we're in multiple trillions. I think it's going to continue to feed on itself as we look at how things move. If there's more volatility in the equity markets, that'll encourage more people to come into fixed income. I think a big defining moment for fixed income was right after Liberation Day when the equity market was super volatile and the fixed income markets had real normalized selling, no panic selling. Spreads widened a little bit, but it was incredibly functioning and snapped back quickly. So I think that's going to encourage more money. And so I don't see this liquidity position changing, absent, obviously if you have serious macroeconomic weakness or a serious spike in geopolitical activity. That changes the entire dynamic for everything. But absent that, I think you're going to continue to see lots of liquidity in the fixed income markets.
Incredible dynamic. Now, Lotfi, you know how more often than not, big fund managers tend to get pretty coy about the idea of giving up their returns. But this week I spoke to Mike Arrighetti over at Ares, and he wasn't coy at all. In fact, that 12 to 15% return number was happy to be slapped on television. Now, what is your view here on private credit? Because elsewhere, people are getting pretty concerned about the marks you don't see.
Yeah. Look, I think the one thing I would say, especially when you compare private to public credit, there is no one-size-fits-all on the private side relative to the public side. And so I do think that once we enter this period of slower growth, and we're not forecasting a recession, we're just saying that the odds of a recession are significantly higher than that 15% long-term average. But once you go into an environment with slower growth, accelerating inflation, and probably sticky cost of capital, I think that will catalyze a lot of dispersion in private debt portfolios. The one example, I think the one sort of perfect illustration of one of the many differences between public and private is that on the public side, you do have well-established benchmarks that have been around for many decades that every fund manager is trying to beat. So when you look at the distribution of returns, say in the high-yield bond market relative to the Bloomberg index, for example, it tends to be pretty close. There is no analog to that on the private side. I mean, in fact, the odds of finding two private debt portfolios that look similar are actually quite low by design. And so as you enter that environment of slower growth, I think, you'll see more dispersion in performance across the funds.
Right.
And that will be a dynamic that will be super interesting to watch in my view. Now, we will experience the first default cycle, just like other markets. There's nothing, special about that, but dispersion will be the theme in my view.
We got to leave it there. That is Lotfi Karoui of Goldman Sachs and Richard Zogheb of Citigroup. And I'm here for it, guys. Looking forward to seeing how both of you navigate that dispersion and talk to your clients through it all. Now, also bringing you some breaking news in the last few minutes here. Stellantis, it is nearing a choice for its new CEO. Bloomberg learned that America's boss, Antonio Filosa, is emerging as the leading candidate. However, the situation does remain fluid and the final decision has not been made. More details when we get them. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread. Coming up, we're going to look ahead to next week's CPI print. Inflation data becoming more crucial with every data release as tariffs began to impact consumer prices. Core inflation is expected to tick up just a little bit, and we'll keep a close eye on how it will be evolving. But for now, same time, same place next week. This is Bloomberg.